So okay, hopefully you've all got this down, all got your questions out the way. So let's tackle supply side. Now, supply side can also be split into two. Although it's not as important basically that you split this into two as for demand side, but I think it is a really useful way of studying it. You have market-based supply side policies, which basically increase the power of the market or decrease the power of the government to try and increase productivity and then increase aggregate supply. And then you have interventionist. Oh no. Interventionist policies. Interventionist policies is kind of the opposite. The government is taking on greater power and greater role in the market to try and increase productivity or efficiency and therefore increase aggregate supply. I should mention as well that typically it is going to be about productivity or efficiency, but the other way to increase long run aggregate supply is to increase the quantity of facts of production rather than the quality. So it's not always about productivity and efficiency, but 9 times out of 10, it is, as it happens. So, okay, market-based, there are loads, but I'll give you a few that are just very easy to use. Deregulation, because you should already understand this from micro. You just kind of need to reapply it to macro. Privatization, same thing. Incentive policy, and here you might start to see some of the overlap. This often means decreasing taxes and decreasing benefits, which is a form of government spending. So you might start to notice, oh wait, there's some overlap here. What else? Labor market deregulation. You can count sort of labor market flexibility, making labor markets more flexible as a separate policy. But if I was talking about market-based policies to make the labor market more efficient, I'd probably talk about deregulating the labor market or something like this. So okay, and we'll do three of each, but again, there is more. The interventionist ones all basically involve government spending on something that it thinks will make the market more efficient. So this could be education spending. This could be R&D spending, one of my favorites, like subsidizing startups, something they do in the UK. If you're a startup company below a certain size, you can apply for basically startup subsidies if you're in certain technology sectors or strategic sectors. So education spending, R&D spending, infrastructure. We could throw healthcare in as well potentially, but that doesn't really say infrastructure. I just ran out of space. There's that bit better, maybe, I don't know. But so okay, we got three of each, and it's again effectively, hopefully you can see how it works. The market-based ones, deregulation, removing regulations, removing government control of economic activity. In other words, that's what a regulation is, right? It's a control on economic activity. Deregulation, getting rid of state control of economic activity, which means the markets, the firms and consumers, they have more power to do what they want, to act as they wish. Privatization, literally selling government assets to the private sector. You're literally moving a sector from government control to private control. Decreasing taxes and decreasing benefits. You are decreasing the amount of money the government takes from the economy and decreasing the amount of money the government gives back into the economy. That's what benefits are, right? It's the government spending the tax money back into the economy to help the poorer people. You are decreasing government involvement in the economy, both in terms of how much they take and how much they give, just making the role of the government smaller. Whereas interventionist, obviously, this all involves government stepping into the market and spending on something. Typically, the interventionist policies are much preferred by students, and I can definitely see why. They're all really, really easy. Education, more skilled workers, higher productivity, higher long and aggregate supply, R&D, better capital, higher productivity, higher long and aggregate supply, infrastructure spending, more efficiency in transport and logistics, maybe lower average cost of transport, particularly important in manufacturing, higher productivity, higher long and aggregate supply. And these are all quite easy to evaluate with things like national debt as well. The disadvantage of interventionist policies is government's going to be spending a lot of money on things like building HS2, for example. If you don't get why that's funny, read more news. Doing all this very expensive, government debt, easy evaluation. So I think these are preferred for good reason. I mean, typically they have more specific or more complex evaluations. But okay, that's our supply side policy overview. Again, sort of questions in the chat. I'll give it like 30, 60 seconds for anyone making notes. Uh, and then I'll move on. I would say like if you want to go a bit further, because this is again broad brush overview, just so that we can quickly apply this to exam questions and you guys will know what everything means. But if you do want to ask a question beyond what I've covered, yeah, just go for it. Just go for it. As long as it won't take me like 5 minutes to answer. It's no problem. And again, get my coffee break. Devak, what does it say below incentive policy? Lower taxes and lower benefits. And the reason this is called incentive policy, anybody? Why would lower taxes? I'll give a clue. The idea is incentivizing people to work more, incentivizing more people to join the labor force, or incentivizing people to work harder. Why would decreasing tax and decreasing benefits help encourage more people to work? Yep, good answer from Drew and Dia. They keep more of the income, exactly. So if you lower the tax rate, people in work are getting more money. So you're kind of rewarding people who choose to work. And then when you decrease benefits, how are you affecting the incentives of people who choose not to work? Should be hopefully fairly obvious. Yes, good answers from Mira. Good. Yes. So they are going to have increased incentive to work people on benefits because they're now getting less benefits. So if you think about it really, really simply, this is increasing the reward of working. This is decreasing the reward of not working. So you're kind of increasing the opportunity cost of choosing not to work